Welcome to the Pursuit of Property, where we have uncensored conversations about business, economics, and philosophy. We believe that life, liberty, and the pursuit of property are just as important today as they were in 1776. This is your host, Max Reimer. I'm one of the co-founders of the John Galt Mortgage Company, and I love discussing big ideas. All right, let's dive in. Welcome to the Pursuit of Property podcast. I'm one of your hosts, Max Reimer.
And I'm Andrew Shermack.
Welcome back for episode 2. And today, I think what we want to cover, Andrew and I both own the John Galt Mortgage Company, and we really want to dive into this issue of home affordability and like what factors play into whether or not people can afford a home. And Andrew, I want to talk to you a little bit about common reasons why you see people get denied for a loan, or what you see when people like their debt to income ratio is too high, and get into the minutia of what goes through our head and our consideration when we're approving a loan. But I wanted to start with the backdrop of this. There was a recent Wall Street Journal poll that came out, and it found that only 11% of people under 30 think they're able to even purchase a home. And 26% of people over 30 think that they can afford a home in 2025. And I just wanted to get your take as we kind of get kicked off here. Why is that?
Because it's probably accurate, to be honest, right now in the housing market.
Yeah.
Where, I mean, it's home ownership for like, especially the like Gen Z below millennials has just fallen off a cliff, and it's for fiscal reasons. It's not because there might be some cope built in a bit. Oh, we like renting, but cause I also saw a stat that still it's 79% of people prefer owning over renting. It's like, I don't know. I think that's 100%. It's just there's just that 21% out there that just kind of like dealing with it. Maybe I just will never be able to afford a house. But
yeah. And like you've done way more loans than I have at JGMC, and I'm wondering, as you're talking to potential buyers, what kind of situations have you run into, or what are the most common reasons people can't afford a home?
Yeah, there's really a plethora of reasons for that. I would say that, assuming you have the credit to qualify, so the bare minimum credit score to even get your foot in the door would be 580 on that, and that's gonna still probably prohibitively expensive when you price in like how high your mortgage insurance would be with that. But that's the bare minimum. But let's just pretend someone has like a 700 credit score. If the reason they're not actually entering like the home buying process, in all likelihood, it could be debt to income ratio. That's huge with younger buyers out there, just because like, again, a lot of younger buyers have student loans. A lot of them are financing cars they probably shouldn't be financing and whatnot. But again, honestly, the biggest reason that I see that is kind of holding a lot of like younger buyers back is coming up with money for the down payment and closing costs. That's pretty significant out there. And I would even say that I don't have like an actual stat on this, but just anecdotally for myself, I would say it's probably around 75% of first-time home buyers are getting gifts from their parents to use towards their down payment or closing cost. It's definitely like a super majority of first-time home buyers are doing that right now.
Yeah, it kind of makes me think about, so Elsie and I, we bought our home 5 years ago in 2020 when rates were really low and the COVID rush had happened, and the market was crazy back then in a much different way than it's crazy right now. And for us, so let me think about this. 5 years ago, I would have been about 30 years old when we bought our first home. And one thing that popped up in that scenario was being self-employed and the rigmarole we had to go through when we were self-employed. And I think about all the other barriers to entry when it comes to the housing market, price, the rate these days, just general perception of affordability, whether or not they can. But on top of that, what we experienced as a family was being self-employed, the extra steps you had to go through in order to prove that you could pay back the loan. Because it's honestly, it's part of my now being a part owner of the John Galt Mortgage Company. I would say it's part of my hero or villain origin story was just how difficult that process was. And do you find that other people have kind of faced the same thing? Like, are we approving a lot of people who would be considered self-employed right now? And do you have any stories related to that?
Yeah, well, I mean, self-employment people, and I speak from this from personal experience as well. There's a lot more hoops to jump through in the underwriting process if you're self-employed, and this all kind of stems from like the Fannie Freddie rules. So this is kind of coming top down federally of like all the extra rules you have to verify your income, just because there's just going to be a lot more kind of hoops to jump through when your income can technically be very variable year over year with that. There's a couple, I mean, just a recency bias example would be last Friday. So this is a Monday. So this is just, again, 2-3 days ago, I had someone where we couldn't count any of his income, even though he's having a great year so far, income wise. But
Really?
2024 wasn't a great year, and 2023 was another good year. So again, you had a good year, bad year, good year. But because when you're approving someone who's self-employed, you have to look at their two most recent year of tax returns. And unfortunately for him, he had a drop in income over 20%.
Was he
In
mainly like his business? Well, if without diving into it too far,
yeah,
what was the industry or what was the type of business that would cause an income drop like that?
yeah. So actually, in his case, he actually works in real estate, and just sheer volume of deals closed year over year was just
Sure.
lower in 24 compared to 23. And even though he's just ripping and having a great 25, well, we don't have any like returns to back up that income off of it. So we have to go off of 24 for it, which
Yep.
was not a good year. And so we just couldn't use any of his income for it. That's why you see a lot of people who own businesses awfully kind of lean towards like the non-QM loan route. So going like bank statement loans and whatnot, where again you're kind of qualifying more off of your cash inflows you have, not necessarily what's being like reported as your taxable income on taxes. So
Yeah.
that's something you see there. But like back to your original question, a good example of this is there was someone. This was last winter, and it was a husband wife looking to buy their very first home. They'd been saving. They actually had a down payment saved up, and they'd been again checking every box that they should do, but they got caught in the crossfire of just self-employment when it comes to
Mm.
Fannie Freddie regulations on it, where she had taken time off. The previous year, she had taken time off maternity leave because she had a baby, so she couldn't go into work at her practice that she owned. And so when she stops going in, when you're an employee of one,
The
there's
income.
just
Yeah.
the income spigot just turns off for it. So it showed that her income was just greatly hit year over year. So due to that drop in instability of income, she couldn't get approved through Fannie or Freddie on it. Which, if you're an employee and you take maternity leave off, that's called a qualifying circumstance. Okay, they just look the
Yeah.
other way on it. But if you own a business, it's just not much you can do, and it's kind of a terrible position to be in between having kids, growing your family, or not qualifying for a loan as a result. I mean, honestly, it isn't really fair, but that's the current rules that are in place right now.
I think back in 2020, when I think about my situation too, I think that was the thing that felt hardest. Again, we're 30 years old,
Mhm.
typically we're going to get into the average age of a first time home buyer, which is depressing here. But typically you're like, okay, I've started this business, I've grown it for 6 years, and then as a business owner, you're always taught, right, to keep your profit low, to keep investing in the business and make sure that your profit on paper is low. So when you
Mhm.
looked at like profit and loss statements, it was this constant friction where I was like, my income is good, my credit score is immaculate, but because of profit and loss, which I'm trying to make look, as bad as possible, it ended up being the situation where I had to go back and forth, and the whole process took like, I want to say, like, we chose the home, we got the seller to agree that we're the buyer, and I think it took like a month and a half or 2 months. It's kind of crazy because I'm sitting here going, well, my employees could get approved quite easily, but I, having an over 25% interest in the business, the rules were totally different. Specifically, do you happen to know like the origin, like with the Fannie and Freddie thing? why self-employment became such a high barrier to entry? Were there people in 2008 starting shell companies, or what did that actually look like, and why is that a rule?
I guess I can't speak to like the history behind that for it, but it basically comes back to being just there's the income's variable off of it. So they're going to show a lot more scrutiny when it comes to the
Sure.
underwriting process because there is no like guarantee that like that's going to be safe. So 2008 messed a lot of things up for mortgage lending in terms of I can't even think of a more like regulated industry than it comes to like
We talk
borrowing money
about
to
it a
buy a
lot.
house. And so,
We talk about it a
um,
lot.
yeah, I guess I couldn't speak to like what was the original like root cause of that, but I would just say it's probably because there probably was a decent amount of fraud in 2008 because there was kind of fraud in everything in housing in
Yeah.
'08, not just people who own businesses. And just like it honestly is just they are going to show more scrutiny because it is variable income. Same thing goes for someone if you work, even if you are an employee and you have like a sales
Commission
type job
based.
where a significant amount is bonus or commission based.
Yeah.
They also show a lot of they show the same level of scrutiny for that they do for like someone that owns a business where you need to show the 24-month average of what your commissions are. Similar to like that's like essentially what it comes down to like for self-employed income. It's looking at what is a running 24-month average of what your net income is, and that's essentially going to be what your qualifying income is
So as
for
you
the
look
loan.
at uh, getting away from self-employment for a little bit here, when you look at a pre-approval or somebody who's filling out a mortgage application, what is like the top three reasons someone gets denied? Is it like mainly a DTI thing? Is it straight up income? Is it credit score? Like right now, us recording this at the end of October in 2025, what are like the main factors you're seeing that basically bar people from entry into a home?
I would say in 2025 for like first time home buyers, it's honestly probably credit. And the reason I think the credit score is the issue is I I think just during the credit boom during COVID when it was a home buying frenzy, pretty much everyone was trying to get into houses back then. So I think we kind of
Right.
ate into the kind of the feedstock for a few years, if you want to use that term, of like potential home buyers in like 23, 24, 25, kind of et cetera. So there's just less home buyers because so many people front loaded and bought when rates were better. So naturally, you're just dealing with people right now that are a little more just dare I say, kind of like desperate trying to get into a house, and often there's going to be some credit issues that may follow that. I would say that's like pretty common why people right now I'm seeing just don't get approved. And on that note, I mean, usually if you have bad credit, you also probably have a pretty bad debt to income ratio because if you have bad credit, that means you have debt that you're not great at paying your bills for. And so naturally those two kind of go hand in hand of seeing kind of tough DTI ratios. But having a bad DTI ratio and DTI just means debt to income.
Yep.
That doesn't mean that you're not approved for a loan. A lot of that's more personal preference. You're maybe just not approved for the loan amount that meets your standard of living
Right.
on it. And I think that's actually the biggest, like a huge barrier out there. I mean, there's a lot of people that are currently renting because again, they're probably paying $1,800, $2,000 a month in rent, where they absolutely are qualified for a loan, just not quite at the amount that they want, where it's like enough for them to make the jump from renting to owning. And again, also again, just another just huge barrier for first time buyers we were talking about is coming up with the down payment and funds they need to close. And just the truth is with that, like a lot of people right now are just getting gifts from mom and dad to help
Yeah.
cover that. And so that's like, I mean, I would say again, probably 70-75% of first time home buyers I've helped are getting help in that are getting help from mom and dad for that.
Yeah, and we hear a lot about, not so much anymore, right? But the last couple of years we've heard about a housing bubble bursting, right? But there's this
Mm,
constricted inventory. And I pulled up the stat real quick, but just like total homes for sale, approximate inventory, right? And this comes from the economic environment that we're kind of in right now. So like 2016, there was about 1.8 million existing homes for sale. So that's pre-pandemic normal supply. 2017, 2018 is around 1.7. And then you start to see it go down in the COVID years, right? To the
mhm,
point where in 2023, that dropped to 1.1 million. And now we're seeing a modest rebound, right? So, like, when I
mhm.
hear about a housing bubble bursting, it's actually and I'd love to get your take on this. It's
Mhm.
actually like there is no bubble. There's like not, in the grand scheme of things, there's not new construction happening the way that it was. So it's keeping prices. And I want to
Mhm.
see if you agree with this. It's keeping prices artificially higher than people would expect.
Yeah. And so, like, I mean, basically since COVID, which I mean, I bought my home in 21. Sounds like you were sometime around that same time frame.
Yeah.
So we're both locked in at like the best rates we'll ever see in our life in likelihood. I mean, we'll probably be buried in our houses
Yeah. I
when you
tell
have a
people
rate
that
like
all the
that.
time. Yeah.
And but yeah, I mean, the reality is, I mean, still, and this isn't like an open secret. This is what the Fed even admits to is like there's just a very significant amount of the population is trapped in their current mortgage. Like I don't feel like I'm trapped in mine. I love it. I love where I live. But
You like being trapped.
yeah, and but there's a lot of people who are trapped in their mortgages where they just cannot afford to sell their house and lose their 3% rate and then buy a new house at a 7% because again, during that same time, home values have just gone through the roof. Which on that note, I mean, Americans are sitting on the most home equity they've ever sat on in history right now. So
Yeah.
home values have gone up a lot. And so there's a lot of people just can't afford to leave. And out there, like the media is always searching for a boogeyman for this. And the reality is it's like,
BlackRock.
it's like
Right.
the truth is it's like it's our own central banking that kind of and like
Yeah.
COVID is what created this monster. So it's a monster of our own creating for why we're seeing this. But again, people say like private equity, it's BlackRock buying all the single family homes. And it's like a tiny percentage of single family homes are owned by like just mega and like private equity investors like
Yep.
BlackRock or so. I mean,
Yep.
it's still like I think it's like 85% of all single family homes that are bought like coded as investment properties are owned by just like people like you and I, where you just like own one or two
Yeah.
on the side like rental properties. It's like a very tiny percentage are those big firms, but they're kind of like the boogeyman for it. And it's like federally they could ban that, which like they could ban them from having any play in the market, and I don't even think it would move the needle
Yeah.
on
Well,
home prices.
I'll just tell you, I know it's a good political talking point, and it is for a lot
Mhm.
of people, especially on my side of the aisle. You know, Republicans want to create this private investment boogeyman, but this comes from the Americans for Financial Reform. It's a group that kind of monitors the financial and housing situation in the United States. And in early 2024, when this was measured, it's somewhere between 2% and 3.5% of
Mhm.
all homes, single family homes, are owned by some kind of private equity. You want to lean into that, right? You want to lean
Mhm.
into get the big bad Klaus Schwabs of the world who want you to rent everything and you'll still be
Mhm.
happy. But like the reality is that it's us, the market, that is
Mhm.
driving the general cost of the homes. It's our behavior collectively, not
Mhm.
necessarily BlackRock.
Yeah, and that's what I say. You could pass a law that forces them to have to sell their houses by year's end, and again, it really wouldn't even
It
move the
would not even
needle.
put a dent in it.
Everyone
Because
right
that
now, everyone right
inventory,
now listening's like these guys are sellouts to
liberal,
BlackRock.
communist, yeah, yeah,
They're
yeah.
one
They're
percenters.
in on it. They're in on it. But you're right. Like that inventory, when you really think about it, is if it came open, it would get snatched up
Hmm.
by the market, by us right away.
Yep.
You had a really interesting statistic we talked about before the podcast about the average age
Mm.
of first time home buyer and then the average age of any home buyer. And I think that's worth discussing because there's like some underlying factors
Well, it's
here.
it's crazy, and a lot of this just shows even the generational difference. Because I still I'm 32 for reference. I consider myself a young American, even though I'm getting
I'm
closer and
feeling old.
closer to
I'm not
middle
that
age.
much older than you, and I'm feeling
And
like
and
a
the
30.
I remember like graduating high school, and this was in 2011, and the economy's kind of in shambles still from like the recession. Housing market's pretty much rock bottom, but prices were really low. And I remember
Yeah.
like just thinking, oh man, I got to get into this investment game. There's single family, you can buy duplexes for 50 grand out there. My only problem is I just didn't have any money because I was 18. And but I remember like kind of my mindset was it wasn't like, am I going to be able to own a house someday? Really, what I was thinking was, how many houses am I going to be able to own? Like that
Ooh,
was genuinely like where I was because I wanted like
you
it
had
was
an
all
abundance mindset, Andrew.
we're like no seriously, but yeah, I was kind of thinking like, man, get a couple rental properties underneath me, cash flow.
You got it
But again, like,
made.
but it was really like that was kind of it was never even crossed my mind. Like, am I gonna be able to afford a house someday? And that just
Yeah.
talk about the difference of what we're seeing from just like one decade to the next. And yeah,
I
like right
do
now,
wonder, hey, real quick to that point, I do wonder how much of that like internalized market crash is in us as millennials. Like I do wonder about that,
Mhm.
right? Because I know my parents' home, I don't know the exact situation, but we bought a second home or I should say a move up home when I was a freshman in high school, you know, and then the market started to crash right away. And my mom and dad, I think it really impacted them, you know, like I think
Mhm.
us and our neighbors, they were like instantly underwater on their house. So I do wonder how much of that psyche plays into the fact that we're really careful today.
Yeah.
If it's not just like a raw financial consideration, if it's
Mhm.
actually generational trauma is the
Yeah.
term maybe you want to use.
Yep. But yeah, like, and again, like as a result of that, like when I was with actually my brother and our dad, the three of us went in and bought our first like duplex bank foreclosure property, and that was in 2012. So I was 19 years old when we did that.
Mm,
When I got married, then my wife and I we bought our first house. Again, it was another duplex because we were just renting out the back unit on that. We were 21 when we did that.
okay.
So like again, pretty young, but it was very doable. It was still very doable back then. Because I remember I had my interest rate on that was 4.5%, and remember thinking, oh my gosh, like what a this is. I remember the time being kind of like nervous about the rate because like oh,
Yeah.
but it's actually pretty good though compared to where it was in
Compounding
the past.
interest.
And now it's like yeah, it was crazy. And so I was 21 when I bought my first home, and guess what? In 2025, so we flash forward whatever that is, like 11 years or so. Guess what the average age of a first time home buyer is in 2025?
First time?
Yeah, first time home buyer. It's also get pretty sad when you look at the average age of a home buyer period, but we'll just start off with first time buyers.
Yeah, I'll say I want to be reasonable here, but I want to say like 32.
Very optimistic. No, yeah, so the most recent year of data is 2024, and it was 38 was the average
For
age of
the
a first time home
first
buyer.
time home buyer.
So even if you and I were to buy a house right now, if we were first time buyers, we'd still be bringing that average down just to show you like how.
Wild.
And the reason that's and before I forget, the average age of a home buyer last year was 56,
Of
which is
any home
also
buyer.
crazy of any home buyer, but
Yeah.
a first time home buyer's was
Unbelievable.
38. And there are definitely societal impacts of having a average home buying first time home buyer age of 38 because there's no easy clean definition to what the American dream is, but regardless who you are, if you were to say what are like three things that are integral to the American dream, pretty much everyone's going to agree upon owning a house or owning
Right.
a dwelling is somehow going to be part of the American dream. And if people can't even begin, if on average it's 38 years old is when people are buying houses now for the
Right.
first time, that means people are kicking a lot of things down the road here. I mean, because a lot of people aren't willing to have kids if they don't own a house. And so, like, a lot of
Yeah.
this shows in the data because birth rates are plummeting amongst millennials compared to previous generation. And it's like, well, no wonder no one can afford houses. And the ones that can finally save up and buy a house are 38 on average. Um, and so we're actually rapidly approaching the point where like the average age of a home buyer is beyond even like child rearing ages at this point, which is there are going to be societal implications from that. Um,
It's interesting, right?
yeah.
Because I think there used to be this mentality of you're going to have kids and live poor and make it work until you've made it. But I think the consensus among especially our generation is that you have to have all of your ducks in a row before you do have kids. And when you consider, we just talked about it, right? So the average age of a first time home buyer is 38. Kids, my understanding is, can stay on their parents' insurance until they're 25. And then as costs go up, because inflation hurts all of us, wages have remained relatively stagnant for a long time. And
Mhm.
so, like, this cocktail of bad economic news, I guess I can't blame millennials
Mhm.
for jumping in head first to a home because frankly, you get into student loans, you have debt, and then your income is the same income it would have been 15 years ago. It's it's pretty bleak.
Yeah.
And I guess I'm wondering, like, in your mind, what is the solution here? How do you fix this in an environment where there is low inventory? People are locked into rates forever that are good rates. And instead of there being a lot of new single family construction, there seems to be more and more rentals that are getting built, which we talked
Mhm.
about on our last podcast.
Yeah, I mean, ultimately it's just, as of right now, it's more of a math problem of like the median price point for a home in the United States is like, I think it's hovering right around $400,000 right
Mm.
now, and the median household income is hovering right around like $75,000 right now, and those are two financial realities colliding because you cannot buy a $400,000 house on 75 a year. It
Isn't
doesn't
that
work.
wild? Yeah.
And so ultimately, I mean, there really isn't like a quick fix on this. So you can't just ban investment properties because again, they make up such a tiny
Yeah.
percentage of the market. I mean, actually, I will say the total share of investments out there last year was like 30% of all single family homes purchased were investments. But again, the super majority of those though
Our
would
people.
be like just normal
Yeah.
people
Me or
buying a
you.
house.
Yeah.
Like, yeah, just me or you, just normal people. Um, but like it's not really like it doesn't even come close to fixing the problem of affordability, even if you just ban investment property purchasing altogether on it. Um, and I mean, ultimately, like higher rates have just it's the rates where they are right now is what has largely crushed the appetite to buy homes and made the financing so expensive because in America we actually the 30-year mortgage is like a very unique financial instrument
Mhm.
that's not present in most of the world. Most of the world, when you buy a house, your interest rate is not fixed for 30 years. It kind of like hovers or resets like every 5 years or so.
Sure. Yeah.
And even when Fannie Mae was first, that was like a depression era, like 1937 or 38 was when Fannie Mae became like a major like investor for home loans. And back then, it was the average down payment was 50%, which is mind-boggling to think of just doing that
Crazy.
for
Yeah.
a first-time home buyer right now. But that's what it was. It was 50%, and the average term on the loan was 5 years, like maybe 10 years, if you were really like a risk taker, just really wanted to finance it. And so, like again, there isn't real to on that note, there really isn't like an easy, clean fix here. We kind of just have to slowly eke our way through this. And like as like baby boomers like start like well, they're all most of them are retired at this point, but as they start like downsizing out of their houses and want to sell, it's going to free up a tremendous amount of inventory. And hopefully that makes more opportunities for Gen Z and the millennials yet who don't have houses. But again, this isn't like a quick, easy fix on this
Right.
either. Hopefully there's just more entry level housing like townhomes, like high density townhomes and condos, just to kind of create more easy, affordable access for building home equity. It's like that stepping stone. Because I'll say my first house, absolute dump,
Yeah.
1906. I mean,
Of
my first
course.
house was older than the Titanic,
Of course. And I
just
think
for
that's how it
reference.
used to be, where you
And
would get a home that you'd put elbow grease into.
mhm,
And I think just because the nature of there not being a lot of new construction comparative to the past, that that is becoming less and less the case. You know, the reason that a
mhm,
lot of these starter homes are more expensive is because a lot of the new builds aren't meant to be starter homes. And I
yep,
think what's interesting, I pulled up this statistic. This is from the NASDAQ, right? In 2025, this is to kind of illustrate, I think, how the pinch is on everybody, right? Because rent is still pretty expensive too. The average national rent right now is around $2,000 a month. The average home ownership cost on a monthly basis is about 27 or 2,800. Does that sound right to you?
yep. That tracks.
And what's interesting, quick side note, but what's interesting is Elsie and I rented a dumpy apartment when we first got married in 2014,
Hmm.
and it was in Edina. It was not the nice part of Edina,
Mm.
Minnesota. There are not nice parts of Edina, Minnesota. And back then, we got an apartment, and we're talking round number about 10 years ago, 11 years ago. We got an apartment for $800 a month. And fast forward to today, I just got curious and looked up what the average same unit cost would be. 1550 a month. And we're talking about a one bedroom, one bathroom, basic apartment, which, by the way, same apartment complex, side note, there was a guy who actually murdered his girlfriend in those apartments and stuffed her in a suitcase and drove her to Louisiana and burned her body. So we got out at the right time, I guess you could say.
That's why you're able to rent for $800 a month.
I guess so. But yeah, there is a general squeeze on younger people, on all people to afford in this market. And as you have, I guess maybe to just tie a bow on this conversation, Andrew, like when you have people who come to John Galt Mortgage Company and kind of they're on the fringe, maybe they can do a home, maybe they can't do a home. What are some of the best practices that you recommend or immediate kind of fixes to make it, one, more affordable, and to make them, two, more appealing to actually qualify for a mortgage?
Yeah. Like, honestly, one thing I tell people is because a lot of first time home buyers can afford houses, just not like the house that they want. And that's something that if someone, assuming they have the credit, they have some money, even if it's like the minimum like 3%, which is like that's the minimum for a conventional loan for a first time home buyer, a 3% down payment saved away or so. I always just encourage people, you should try to get into a house, even if it's like a fixer up, or even if it's not your dream home. It's a stepping stone. Like that's what every other generation, like when they got into their first house, it typically was like not the greatest house ever, but again, you have to start somewhere for it. And that's why I encourage people to do. And like, if it's for credit reasons, I'll just coach them on credit repair. Just make sure you're paying your bills on time. Like don't buy a car where you have like $1,000 a month car payments. You'd be surprised how many of those I see where there's someone renting and they're literally paying like $1,000 a month for just an auto loan. It's like, and so a lot of it's just kind of more financial literacy education, I guess, is what I'll do with like people that are in that boat. But like whether it's credit repair, but generally a lot of people that are first time home buyers out there can afford housing. It's just maybe not like to the caliber of what their expectations were, because their expectations are based off of like buying a house in 2013 or so.
Right.
And it's like, dude, times have changed. It's different now, but you kind of got to get in, because the people I feel the most bad for aren't people that are first time home buyers buying a home at age 38. It's for the people that are like age whatever, say 33 or so, and they're just like, well, I'm just gonna wait for prices to come down, because I don't really see that happening in the near future. Like,
we just spent a whole podcast outlining why that is not a safe assumption.
And that's like something too, is like every time I talk to like a first time home buyer, like when they get to the closing table and they're closing, assuming they're not like 22 or they're like super young, but they're like, say, call it my age, 32. The number one thing you typically will hear them say is, oh, I wish we would have bought a home earlier. I wish we wouldn't have gone the Dave Ramsey route and paid off our student loans first before buying a house. I mean, typically the thing what you always hear is it's kind of like almost like some remorse about just not pulling the trigger earlier, because home values have kept going up and up and up during that time. And it kind of seems like that's the trend line we're just on now. So
yeah, I think as we think about this, and for the people watching this podcast, if you're in that younger age bracket and you're looking to move to that next season of your life, what we're essentially recommending here is start earlier than you're comfortable with. Start with a property that you may not be fully comfortable with, and then do the fundamental things to both repair and enhance your credit, and have some hope, right? Because like as long as you have the right expectations, we see it, and it's been like this for a long time in America. Owning a home and building that equity is the best propeller towards wealth for most people. And if there's any way that we can impart this on you as you're watching this podcast, it's to start a little bit earlier than you're comfortable starting, and to start with a home that you may not be fully comfortable with, because you don't have to be in it forever.
yeah. And on that note, like I always will coach for especially first time home buyers on this, that like just because you're approved for a property doesn't necessarily mean that should be the one you pull the trigger on. Just because if it's like your debt to income ratio is like 49%, where you're technically approved for it, doesn't mean it's like the safe option for you to do financially either. And that's why I say, and again, that's what I mean when I say like a lot of people have like unrealistic expectations for what their first house should be. Like maybe you have to drop your purchase point price by like $50,000 or so. So your debt to income ratio is 38, not 49.9, because that way you're not at risk of like literally going into foreclosure if
Right.
anything happens. So like again, everything is like relative, and so so like again, kind of within reason. But yeah, just people like again, the reason the average age is 38 right now is probably because there's a lot of people that have just been kicking the can down the road, and eventually push comes to shove, they know they got to get into a house, and they're just doing it later in life now, and it's costing them a lot more than if they would have just done it when they were 32, 33. So
There's that old Chinese proverb, right, where it talks about when is the best time to plant a tree 30 years ago, when is the second
yeah,
best time to plant a tree today.
Mhm.
And not to say that you want to make an irresponsible financial decision, but I think for a lot of younger people, they are waiting for all of the stars to align to have children, to get a home, to take the next step in their life, to get married. And if Andrew and I can basically wrap this up with anything, it's that you're never going to be fully comfortable when you make a decision like that. And I think that's an important thing. If we're going to drive this forward, if we're actually going to bring costs down long term, if we're going to be economically significant factors in this world, it means being a little bit uncomfortable and resetting your expectations about what you deserve. So, Andrew, I'll leave you with the final comments here on the Pursuit of Property podcast.
Yep. And that's a first time home buyers, especially for Gen Z and millennials yet who have to buy houses. Like, don't lose faith. Like, definitely just keep saving. Do what you can control, what you can control on that.
Amen.
And I would just try to get into that house as soon as you can on it. And again, it doesn't have to be in the nicest neighborhood or the nicest town, just a stepping stone, like the first place to start building equity. And I wouldn't delay, because as Americans, we need to start reversing this trend of waiting till we're 38 to buy our first house, because there's going to be a lot of negative consequences that are going to come after that. So
fabulous. Well, I'm Max Reimer for my co-host, Andrew Shermack. This has been The Pursuit of Property, episode 2. We'll see you next time.